Good morning and welcome to MarketCast 38 from a very damp south coast. But here's the thing that I want to start this webcast off with. Summer's on the way. Have you noticed that? It's the driving home thing, isn't it? You're driving at 4:30, 5 o'clock and suddenly now it's still daylight. So summer is coming. But it's not just something to look forward to. That's something to be slightly concerned about. I want to touch on that today. Let's kick off with looking at where we are right now and where I think we're going to go. I want to talk a lot about affordability today and how that is running markets. That's having a really profound effect. And I'm going to touch on that later. But in the meantime, if you cast your mind back to our December MarketCast, our January MarketCast, where we talked about the artificial manipulation of the market, where we talked about this move away, what has become the new normal in terms of volume. We've seen this, haven't we? This metamorphosis of the new post-COVID normal in terms of volumes being artificially squeezed by the budget paralysis and then by Christmas after it, creating a situation where people who needed to buy, not just who wanted to buy, were unable to do so. And we always believed, I certainly always believed, that we would see the results of that, those buyers coming to market in Q1 of 2026. And so it has proven to be. Now, I believe they're there right now and they're to be taken advantage of, but I couldn't resist asking AI to give me its very best impression of if we didn't get those beautiful spring flowers and stick them in the vase while we had the opportunity, what that might look like when summer approaches. Well, and there we are. That's the AI version of it. Let's get into some of the detail. Of course, it's a big day today, isn't it? Because we've got the MPC decision coming up at noon. We'll come back to that a tad later. What's going on in the media and what's being said in the media? One thing that I thought was really interesting when I did my little swoop of the media yesterday evening, some people have accused me of having this show not being live. Let me tell you, it absolutely is live this morning at 8:32, and I did a sweep just yesterday evening, and I always go and have a look in the mail. I always want to know what the mail is saying about the property market, and I picked this story up and I thought, well, that's bizarre because that looks really familiar to the story that I was talking about on last month's MarketCast. And despite the fact that this is all today's date up there, the unemployment story set to rise in 2026 and the effect it's going to have on house prices is running like it's today's story, and that story dates back to the back end of last year. There's quite a bit of that going on. Elsewhere, Santander have come out with their 98% mortgage. I believe that to be able to qualify for that, you've got to be able to speak 7 languages, stand on one foot for 3 hours and hum the Marseillaise. But apart from that, no, it's not a problem getting that. The nationwide numbers came out, didn't they, this week? And all of the press have picked that up. We've seen a lot of that going on. Lots of people talking about the London market and the issues in the disconnect in the London market and the reduction in numbers. What I did find fascinating, looking more towards the trade side of the media, these two stories were 5 days apart, 4 days apart. Falling mortgage rates spark new hope for home buyers. Whoopee! 3-4 days later, major lenders increase rates on mortgage products. What's been going on in the background, I understand, I have it on very good authority, that the Japanese government have decided to loan fund this enormous spend at home in the domestic market in Japan. That has spooked global bond markets. So the consequence of that is we've seen swap rates go up 3.55% up to 3.75%. Those swap rates then spook all the institutions all around the planet, the global institutions around the planet, and eventually it comes back to us and mortgages and building societies in the UK. And when we get to look at where the money rates are going in a minute or two, have a little look at the long-term money, the 10-year money, you'll see what I'm saying. And so that gives me a little bit of a cause for concern. But let's take a look at the headlines. All the indications is that this first quarter is actually turning out as we thought it would. when I spoke to you at the back end of last year and certainly in last month's MarketCast, there's real opportunity out there. Of course, Rightmove weighed in, didn't they, with their January numbers going up a record. I think it was 2.8% in their January numbers for asking price increases. That, I believe, is an all-time record for the Rightmove increase in asking prices. Nationwide, well, last time we used the P word. We used the plummet. We had the plummet word in there, but it's actually arrested this plummet and it upticked. Again, something we expected to happen in the January numbers. Consumer confidence, it continues to improve. There was an anniversary with this month's GfK consumer confidence numbers. It was 10 years to the month. January 2016 was when that index went into negative territory, and it's been there ever since. It's the 10-year anniversary of UK consumers being more negative about the next 12 months than positive. Interest rates, I've talked about these swap rates. Look, the few odd little signs, those first couple of little drips of rain that you feel when you're out on a sunny day, a little bit of concern there. And of course, inflation blipped up, but we'll come back to that and look at that in more detail. Crucially, the OOH, the owner occupier housing costs, inflation-wise, have continued their fall. That's very good news. Mortgage rates have edged up after coming down. They've now edged back up again. Everybody a little bit nervous, but crucially, the suppression of that needs-based market in the last quarter of last year has created an opportunity for us in the first quarter of this one. Right, okay, let's unpack some of that, but let's start off by looking at the really important numbers. Well, the inflation figures, we saw them last month go up to 3.4. Next ones are out on February 18. They're going to be very important to us before the March meeting of the MPC. This is where inflation currently stands. The CPI, which is now the Consumer Price Index, which is the measure now that all the national media pick up. I think the only people that still pick up RPI are the junior doctors. I shouldn't complain. My daughter's going to be one next year. So the CPI, though, actually went from 3.2% up to 3.4%. But look at this. For our customers, as far as our target audience is concerned, the OOH inflation continued to fall down from 4.5% to 4.2%. So here's our CPI in here, and here are our owner-occupier housing costs in here. And this, even with this little uptick here, this continues to fall. And I genuinely believe the uptick is going to be just that, because we're now coming into that period in the year last year where there were some significant kicks up and increases. That inflation, by the way, that rise of inflation, by the way, has been fueled. If you actually dig into the numbers, I haven't got time to really do it here this morning. Dig into the numbers, been fueled by alcohol, tobacco, restaurants, hotels. Heavens, it sounds like a typical week for me, that really. It's no wonder I'm so poor. But these are not the things. These are not the things that your average family home buyer is going to worry too much about. I don't know, maybe the odd sniffer. But the point being is, I think that we will see inflation coming back on that downward trajectory very soon. Certainly in time for that meeting on the 19th. Okay, we've got the meeting today. What's going to happen? Well, I'm 95% certain it will be no move in interest rates. I'm sure if you've listened to Radio 4 Today programme, whatever, all the economists that they get on there reckon that the rates are going to stick. I can't see them being wrong. I would be amazed if they move today. They certainly won't go up today. Of that, I'm absolutely certain. There is a tiny possibility they could come down to 3.5, but I doubt it. I think they're going to stay at 3.75. I think the 19th of March meeting, where we could very easily see a 25 basis points cut, would depend on what the inflation numbers look like on the 18th of February. And I think those numbers could be good news. We'll see. So this is where we currently are. 3.75, potentially today could come down to 3.5. I doubt it. I think we could almost certainly discount that. Certainly not all the time that the inflation rate is sat at 3.4. You all know the trajectory of interest rates. I don't need to spend any more time on that, do I? in terms of where we are going with volumes, this is so closely tagged to affordability. So on mortgage approvals, we did take a slight tumble in December. They actually fell to 61,000. That's not worrying me in particular. If you look back at all the previous Decembers, that's about right. It still means that we are on track for this classic 1.2 million plus. My forecast for this year in terms of volumes is 1.275 million, and I have no reason, as things currently stand, to believe I'm going to be very far out with that. So mortgage approvals, I think, are in line with expectations there. Nothing in there that gives me cause for concern. Where interest rates are moving, so if we look over here, these two charts, by the way, all of the lines on that chart over there are for a 2-year fixed term. The different lines on the chart are different loans to value. Obviously, with the very highest one at the top there, 95% loan to value, and the very lowest one at the bottom there, 60% loan to value. And you can see generally how those rates are moving. I've given you a nice little guide up here in the top left-hand corner. Right now, average rate, and I stress average rate, for a 90% loan to value mortgage, 2-year fixed, is just under 4.5%. They'll vary around there. Over in this chart on this side here, they are all the same loan to value, 75%, and the different lines and different colours are the different fixed terms. So here's our 2-year, 3-year, 5-year in here. Look at where the 10-year money is going here. And that gives me some cause for concern, because the markets, they tend to know this stuff, don't they? You know, your mate Mandelson rings your mate Epstein. You know, I'll tell you what, this is what's going on behind the scenes. They happen to have a spooky way of knowing what's going on behind the scenes that you and I don't. But that long-term money gives me the slightly uneasy feeling that rates aren't going to come down as quickly as we'd hoped. Well, I'm gone into Nationwide early this morning because I want to talk about affordability, specifically about affordability this morning. And the Nationwide always put their affordability charts in there. But while we're here, you can see the Nationwide, well, it popped up after its plummet in December. It's come back, and it's 0.3% rise in the month in January, which took us up to an annual change of 1%, 270k roughly, 271k, pretty much what we predicted it would be at the end of January. There's nothing in there that gives me any cause for concern or surprise whatsoever. But just digging behind the headlines briefly, I have said, I don't know, this is MarketCast number 38. So this has been running over 3 years. We've been doing this. And back in the day, I used to put this chart in every single MarketCast presentation. And when we would up here doing this and right at the top here, go back and have a look. And I'd say, let me tell you, this will come back down to this line as sure as night follows day. That line through there, which sits at about 5.7 times income, is the 25-year average. So housing mortgage costs run at about 5.7 times income, and it has done for as long as we've got records to actually discover the number. And I've said, I promise you, this will come back down. It will absolutely come back down. That goes all the way up there because the interest rates got so incredibly low after COVID, down at virtually nothing. And that meant people borrowed and borrowed and borrowed. But once the interest rate finds that equilibrium, that comes back down to that line. And sure enough, it has. And I'll tell you who's right on the case of how affordability is dramatically affecting markets. It's Zoopla. They've produced some really nice numbers actually this month. I like this. This was a chart. Well, I produced the chart, but these were numbers published by Money Facts. So what Money Facts did was they took the average gross salary in the UK. They then took the average house price, according to the Land Registry in the UK, and then they took the average mortgage rate, and then they calculated from June 2020 up to what it will probably be this year, what percentage, what share of a buyer's gross monthly salary is needed to meet their house purchase cost. A fascinating bit of work. And you can see back in June 2020, this is COVID time now, we're just getting ready to come out of COVID, it's right down here around 36, 37%. And at the peak, when all the interest rates started going through the roof, it got up here to almost 50%. And it has then been steadily falling as those interest rates have come back down to more closer to normality. And here we are now. This is roughly where we are now here. This is 2026. And these are their predictions. So if it's 2026 and interest rates fall lower, that could come down to about 40%. If they stay higher, 41, 42%, best buy and good credit risk. So people with a big deposit and people who are very good credit risks can see their rates or their share of their gross salary needed to buy their house coming down as low as 37%. Now, I took that chart, which I thought that was a really fascinating piece of information, and I have superimposed on it the property mark chart of properties sold at asking price or better. Have a look at this. Ready? So these are the property market numbers as early as I've got them. So I take you back here. So here are property mark numbers in 2022, but January 2022 up here. So the deals done at asking price and better up here. Then as the percentage of income required to buy a property climbed exponentially as we came out of COVID, look what happened to the deals done at asking price or better. And then as this evened out, well, then this evened out. The correlation between those two is so obvious, it is unavoidable. That affordability. And let me take that one step further. This is the Zoopla chart that they put into this month's report, and you can see here how the price has been moving all across the UK in the regional markets, absolutely in line with affordability. That's what's going on. So here, where affordability is very difficult, Cambridge, central London, the south coast, the southeast, all of that where affordability is very, very difficult, you've actually got negative price growth there. Is that really a thing? You've got price falls. That's what I mean. Then as affordability improves as we come up here, you can see there, then you've got positive price growth. And I know it sounds a bit like stating the obvious, but the reason I wanted to focus on it this morning so strongly was this Q1 is a really great quarter opportunity to take advantage, but I believe we need to be competitive with price. I think it would be a mistake to say, hello, things are getting better, we'll sit back and enhance our margins, because I think that opportunity might be gone come summer. And what we can do by working with the IFAs and doing other things is we can make this affordable. Certainly we can make it very affordable across a 2-year term, and so we can actually move that affordability scale, and we can move it further along the line, which will have a dramatic effect on sales rates. Believe you me, I believe that passionately. Quick look at some of the key data then. So I told you about this right move, 2.8% up in January on asking prices. Is that people being silly, or is that people being ambitious, or people being confident? One thing's for sure, it's the biggest ever right move index rise in January, that's certain. The Zoopla numbers, well, we've looked already at some of the Zoopla numbers, very, very good. But you can see this is roughly where they are, almost exactly where we thought that the market would be. 1.2% house price inflation annualized. So here's another great chart that I always look at on Zoopla, but I've got to tell you that this month and next month, this really isn't going to help you too much in terms of information, because I ask you to cast your mind back to this time last year. And of course, it was the stamp duty dash, wasn't it? Do you remember? We had the stamp duty relief being taken away at the end of March last year, which meant in January and even December 2024 to a certain extent, but certainly January 2025, February 2025, we had people dashing to get deals done before that stamp duty benefit got taken away from them. So although here Zoopla are saying buyer demand down 9%, I'm not in the slightest bit concerned about that, because it's a bit of a faux comparison. Number of sales agreed down 7%. Again, the same applies. I think the underlying picture. If you look at these numbers and rather than compare them with last year when the stamp duty rush was going on, look at these numbers and they are well above the average post-COVID, that's for sure. The RICS, our good old friends at the RICS, those ever there optimists, come on guys, get the champagne out. Nobody flung themselves out of the window this week. So the December survey, they actually, as you know, even the way January is shaping up, they can't bring themselves to go, whoopee. Its activity levels remain subdued, but forward-looking metrics turn noticeably more positive. Calm down, guys. Calm down. It's the December survey is a pretty good one, actually. I've restricted this. So the December numbers, November survey. So I've restricted this to talking about sales rates and price expectations. And look how this has moved. The dial has noticeably shifted. And you can see now that the majority of surveyors believe that volumes are going to climb next year, exactly as I do. To be fair, I could have been a surveyor. And they also believe, even in the short term now, that volumes are actually going to move ahead of where they were this time last year. So that's their 12-month expectations, 3 months expectations, both now in positive territory. And then if we switch that over to price and price expectations, where they feel that values are going to go, the short term 3 month is still in negative. So which means that the majority of the surveyors still believe that there is price pressure, downward price pressure on over the next 3 months. And I think that's probably fair, but they think that on an annual basis, look at that. That's really a very strong majority of surveyors believe that over the 12 months, we will see price rises rather than price falls. I think this all fits absolutely with the scenario that we set out for you in November of last year and again in January. This absolutely fits with it and reassures me that we might be a percentage point or two out, but we're certainly on the right track as to where values are going to move, notwithstanding any major geopolitical events over which we have no control. And I've deliberately put this slide in from last month's deck because it is such an important factor in what we're doing and how we manage our sales strategy and marketing strategy over the next 2 to 3 months. We are talking now in the main to a needs-based market that actually had to sit on their hands in Q4 of 2025, budget concerns, Christmas and everything else, and now are in a position where they have to make these decisions and they have to make this move. And the thing is that if you're talking to a needs-based market, the way you get successful is you identify which particular needs which particular prospects have. And so that comes down to micro marketing. So this is really, that's that lovely little area, you know, that little area over behind the trees, around the back of the bicycle sheds, where marketing and sales get together and have a sneaky cigarette. This is literally where those two disciplines join. And the key of micro marketing and identifying warm prospects' needs so they can be addressed directly will bring significant dividends, that's for sure. Okay, so in terms of the classic matrix, this is where we were last February. It has really changed. It was fascinating to actually, I looked at this yesterday evening. It's fascinating to see what changed. Last February, of course, stamp duty. This was all we talked about because we were coming up to that big change at the end of March. So it was having a serious high impact effect. And of course, people were running out of time. It was in negative. Low affordability down here. High mortgage rates in here. Look at this. And here's consumer confidence. Stuff like hot employment market, unemployment, if you like, were over here, low impact. And also, we hadn't even invented at that point. We had to wait for the new Labour government and Rachel from accounts to actually bring this in as a concept. We hadn't even invented the uncertainty index. That's added in red to the new chart. This is where we are now. Have a look at the way that has moved. It's quite extraordinary. So Low affordability is right up here. And I've shown you that chart. We are now back down through 5.7 times income, for the average purchaser. We are now back down below that line. Low affordability is moving towards the centre. Mortgage rates moving towards the centre. Here's our uncertainty index in there, not what it was prior, just before and just after the budget in November, but you can see where it is now. Consumer confidence still in negative, but evening out. Look at this employment market. That's a very important early warning sign. I do believe it matters. We have now just gone through 4 straight months decline in employment levels. And in fact, this month was the biggest month-on-month fall since November 2020 in terms of employment. That does matter. Keep an eye on that. And of course, up here, we still have all of the tools that you have at your disposal, the tools that are actually in your gift, which are still incredibly powerful. And right now, where you've got quite a bit of product on the market, but a market that's receptive to that, part exchange sits like the jewel in the crown at the top of the tree. That really is a very, very effective tool right now. Look at mortgage availability. Is right over there. It's low impact. I think the lenders are falling over themselves to lend money. So the availability of mortgages, not the rate, but the availability is now much less of an issue. And also, of course, there's been relaxation on criteria as well. Okay, so where do we go then in 2026? Well, I'm sort of starting to feel confident about this. I think this now is fairly clear as to where we're going to go. If we actually look at what happened in January, so you'll see as we go through the year on MarketCast, you'll see these light blue blocks turning dark blue as soon as they become actuals rather than forecasts. We're taking the nationwide numbers. Everybody that does the market forecast, lots of people rely on land registry. The big issue that I have with land registry, number one, is it's always so far out of date. The best numbers you can get on land registry at the moment are last November. Now that for me isn't a great help. And number two, they get revised. So they give you a number and then a couple of months later they say, that number we gave you? Well, here's the new version of it. And so for me, I wanted something that was much more instant, much more tactile. And the thing is, don't forget the principle of consistent inconsistencies. No price index that takes an average price across the UK is perfect. And when if you look at the Zoopla report, by the way, for this month, and you look at their lowest performing region on there, which I think is Bournemouth, where I'm speaking from right this very minute, which they've got in at minus 2.2%, so price fall, right up to the top, which I think at the moment is Burnley, which they've got up at 7%. You've got literally 7-8% difference in local and regional markets. So averages are always imperfect in a big way. But the good thing about the nationwide index is twofold. Number one, it's a really good indicator of trends. It's not perfect. The algorithm isn't perfect, but it's a really good indicator of trends. And number two, the media love it. And it means that this is the stuff that's going to feed tomorrow's headlines. And tomorrow's headlines are the things that are going to inform your prospects and your potential buyers. So that's going to get right in their head. And I think this is what we're going to see. I think we're going to see a bit of price growth through the spring, but I think it's going to be a lean summer. It's going to be a difficult summer, but I think there is every opportunity for a really strong bit of growth come the autumn as well. Ending up the year around about 1% growth. It will be very similar to where we were last year, in my view, very similar. This is the average price up here. So we've kicked off now with a nationwide just under 271,000. And you can see, I don't think it's going to go too far away from that as we go through the year. I think it might well touch a record 274,000 at the peak of the spring. But that, I think, is where we're going to be. So in summary then, the expected upsurge, the expected swing upwards that we predicted in quarter one looks very likely to happen. Certainly all the numbers that I'm seeing all the reservation rates that I'm seeing, the reservation rates right now, they are the highest they've been for about 4 years. So let me tell you that this looks like it's happening. Summer, I think, could prove difficult. I think that once we've got this surge out of the way, so the people that were waiting in Q4 of last year have gone, then I think that's a bit of an issue. There are a bit of pressure on rates going upwards. That will dent confidence. So I think that could be an issue. But I think that there is every chance we could see a very strong end to the year. Forecast for price inflation for 2026 stands at around 7%, around 1%. Volume forecast for 2026 stands at 1.27 million. Neither of those things are going to change. New home share, I've still got in there at 10%, but I actually have a feeling that if we get commercially aggressive, that's the best phrase I can use, I think that could potentially climb a little bit. It will be essential, absolutely essential for everybody watching this market cast to take advantage of the opportunities offered in Q1 of this year. I've called it the Great Spring Cleanup, and I think that's probably the best way I can put it. Thanks for joining me this morning for half an hour high-paced stuff. For AF Oliver clients, by the way, your account management teams will have access to a much bigger deck behind this, so they can dig down, speak to them, because they can dig down into the detail behind some of these headlines. Trying to squeeze a market presentation into 30 minutes is tricky at any time. But hey, we'll see you. We'll be back with more of the same, hopefully, in about a month's time. In the meantime, keep selling, and I'll see you then.